Welcome back to the Byte-Size Brief. Today, we're going deep on Supermicro, ticker symbol SMCI. Now, this is a company positioned right at the absolute epicenter of the AI revolution, but right now, they're battling some truly massive internal and external turbulence. Just to give you a sense of why this demands your attention today, in the last few months alone, we've seen them announce groundbreaking new AI infrastructure, post an absolutely massive blowout quarter, but at the exact same time, they're navigating shrinking margins and some really severe legal headwinds. It's literally a corporate tug-of-war, and we are going to break it all down for you. Here is how we're going to tackle this. We'll start with the Supermicro paradox, do a quick tutorial on their AI server engine, dig into their growth versus their shrinking margins, weigh the intense bull and bear arguments, and finally, look at the road ahead. Section 1, the Supermicro paradox. Okay, to really get what's happening with SMCI today, you first have to grasp the incredible paradox they represent in the market. It's a situation that has completely divided financial analysts. Seriously, think about this. How does a company grow its revenue by an explosive 123% year over year, yet still see its stock price face extreme whiplash-inducing volatility? Well, on one hand, you've got this undeniable hypergrowth driven by an insatiable global demand for AI. But on the flip side, you have shrinking profit margins, a cash cycle crunch, and the looming dark cloud of federal indictments. It's a classic, high-stakes clash between incredible business execution and massive systemic risk. Section 2, the AI server engine. To make sense of those financials, we really need to understand the why and the what. Let's do a quick one-on-one tutorial on how Supermicro actually makes its money. Think of their business model like high-tech Legos. They use this brilliant plug-and-play modular building block architecture. This setup allows them to rapidly assemble and customize entire server racks for data centers way faster than legacy competitors like Dell or HP. When a massive tech company needs to deploy a huge cluster of Nvidia GPUs, Supermicro's rack-scale integration means they get that data center up and running fast. And in the AI gold rush, time to market is absolutely everything. And that brings us to their real secret weapon, their unique moat, liquid cooling technology. As these next-generation AI chips get exponentially hotter and way more power-hungry, traditional air cooling just doesn't cut it anymore. Supermicro has completely mastered advanced thermal management at scale. Industry analysts estimate this liquid cooling tech can increase rack compute power by over 2 times in power-constrained data centers. It's not just a nice-to-have, it solves a very real, very physical bottleneck for their buyers. Because they've nailed this deep integration and cooling capability, an estimated 70% of Supermicro's entire revenue is now directly tied to AI use cases. They are fundamentally tethered to the AI boom. When Nvidia succeeds, Supermicro scales right alongside them. But that's a double-edged sword. It also means that any potential cooling off in AI infrastructure spending will hit them disproportionately hard. Section 3, growth versus margin squeeze. Let's see how all this hardware translates into their recent financials. Looking closely at their Q4 calendar year 2025 earnings to see what changed quarter over quarter, the contrast is just staggering. The revenue story is incredible. They absolutely crushed expectations, bringing in $12.68 billion, up from around $5.67 billion the year prior. I mean, that is the definition of hypergrowth. But look at the operating margin. It actually fell from 6.5% down to a concerning 3.7%. So what gives? Simply put, the sheer cost of scaling so rapidly, combined with some aggressive pricing to steal market share from competitors, is eating right into their profitability. They are generating massive sales, but it is costing them quite a bit more to do it. Now, despite those margin pressures and the fact that they're operating with negative free cash flow, management just made a very bold move. They aggressively raised their full-year revenue guidance to a midpoint of $40 billion. That is a massive signal of confidence. It's management's way of telling the market that they foresee robust, continued demand for their AI servers, heavily driven by their new product pipelines. But, and there is always a but, that $40 billion guidance has to be weighed against some very real, very recent headwinds. For instance, they recently faced the cancellation of a massive Oracle contract, which was estimated to be worth anywhere between $1.1 and $1.4 billion for hundreds of Nvidia racks. This situation perfectly highlights the severe customer concentration risks they are dealing with. When a huge chunk of your revenue comes from just a handful of hyperscalers, losing even one single contract leaves a very noticeable dent. Section 4, the bull versus bear battle. All right, so this brings us to the core debate among financial analysts. Let's objectively break down the competing forces driving this stock so we can really understand what the market is pricing in. Right now, the market is completely divided. It's a true tug-of-war. On one side, you have these undeniable hypergrowth metrics and massive market share capture. On the other side, you have existential risks regarding margin erosion and some severe legal overhangs. Let's start with the optimists. The bull case is totally anchored in execution and scale. They're pointing straight to that 123% year-over-year revenue growth. They also highlight Supermicro's recent announcement of their largest ever U.S. facility, which proves tangible, real-world capacity expansion. Plus, the launch of their new ARM-based systems and Gold Series servers proves they're rapidly innovating. Because of all these factors, the analyst consensus currently holds a target price of around $33. That represents a roughly 19% upside from recent trading levels. The bulls argue that, given its pivotal role in the AI ecosystem, the company is fundamentally undervalued. But to stay completely objective, we have to talk about the legal elephant in the room. The crucial sticking point for the bears revolves around an alleged export control violation scheme. Now, strictly sticking to the facts here, we have to highlight CEO Charles Lang's public statement. He explicitly stated that Supermicro is not named as a defendant in the U.S. DOJ indictment. He claimed the company was actually deceived by 3 former individuals and was essentially a victim in the matter. Since then, the company has promoted a new acting chief compliance officer and strongly insists this has absolutely no impact on their daily business operations, which fuels the bears' case. Because despite management defending their position, the bears are roaring. They emphasize the gravity of the ongoing DOJ investigations, alongside a massive wave of shareholder class action lawsuits alleging revenue concealment. Even if the company itself isn't indicted, that kind of legal overhang shatters institutional trust. Add to this the very stark reality of their operating margins shrinking to 3.7% and aggressive competitive threats from legacy giants like Dell and HPE, who are actively swooping in to absorb lost clients. For the bears, hypergrowth doesn't mean much if you can't retain your profit margins and keep your boardroom out of controversy. Section 5. The Road Ahead. With all this high-stakes AI hardware and legal drama swirling around, what should you actually be paying attention to in the coming months? Here are the key catalysts you need to watch. First, the next earnings release. Investors desperately need to see if those margins are stabilizing. Can SMCI maintain their market share without totally sacrificing profitability? Second, keep an eye on the ongoing legal resolutions. Can the newly appointed acting chief compliance officer successfully restore institutional trust? And third, watch their future product deployments. Their ability to successfully roll out the next generation of Nvidia clusters is going to prove once and for all whether that liquid cooling moat is truly as defensible as the analysts claim. So, we're left with the ultimate question. Can Supermicro's AI hypergrowth engine run fast enough to outpace its shrinking margins and legal clouds? It's just a fascinating, real-world business case of incredible innovation battling heavy execution risks. That wraps up today's deep dive explainer on Supermicro. For a sharper, more candid discussion, be sure to join us on the full audio explainer and definitely drop your questions and hot takes in the comments below because we read every single one. Thanks for joining us, and we'll see you next time.